The global market right now feels like it's standing on a fault line, steady on the surface but with pressure building underneath. Over the past few days, investors have been pulled in two very different directions. On one side, there's optimism, powered by strong corporate earnings and the relentless momentum of artificial intelligence. On the other, there's a growing sense of unease driven by geopolitics, rising oil prices, and uncertainty around interest rates. And it's this tension that's defining the market mood. It begins with oil. Prices have surged to levels not seen in years, briefly touching what traders are calling wartime highs. The reason is simple: escalating tensions around Iran and the possibility of renewed military action. Whenever that risk rises, oil becomes the first and fastest signal. But this isn't just about energy markets. Higher oil prices feed directly into inflation, and inflation is the one variable central banks cannot ignore. So, even as equities try to hold steady, this spike in crude is quietly tightening financial conditions in the background. At the same time, corporate earnings have delivered a very different story. Big tech has come out strong. Alphabet and Amazon are showing that the AI boom is not just hype, it's translating into real revenue growth, especially through cloud businesses. Microsoft has also reinforced this trend with stable and expanding enterprise demand. But not everyone is benefiting equally. Meta Platforms is facing pressure. Its aggressive spending on AI is worrying investors, raising questions about profitability in the near term. And that's an important shift. The market is no longer rewarding AI ambition alone. It wants disciplined execution. Meanwhile, in Europe, banks like Standard Chartered and BNP Paribas have delivered better than expected results. That signals resilience in the financial sector. But it also comes with a catch, because central banks are still in a difficult position. The Federal Reserve has paused rate hikes, but it's far from united. There's a clear divide within policymakers about what comes next. Some see room to ease, others remain cautious, especially with inflation risks creeping back through energy. And that uncertainty is critical. It means the path to lower interest rates is not guaranteed, and markets that were hoping for quick cuts may need to adjust expectations. Across the Atlantic, the European Central Bank and the Bank of England are also expected to hold rates steady. But Europe faces an added challenge: slowing economic growth combined with rising energy costs. That combination is dangerously close to stagflation, and if that scenario develops, it could weigh heavily on European equities and global risk sentiment. There's another layer to this story: the AI race itself. Companies like Anthropic are attracting massive valuations, with funding discussions pushing toward unprecedented levels. At the same time, regulatory resistance is beginning to emerge, particularly from governments concerned about control and access to advanced AI systems. So, while AI is driving growth, it's also introducing new risks: regulatory, competitive, and financial. Put all of this together, and you get a market that is not moving in one clear direction. Instead, it's balancing. Strong earnings are supporting stock prices, but rising oil is reviving inflation fears. Central banks are pausing but not committing, and AI is creating both opportunity and uncertainty. Looking ahead, the next move in markets will likely depend on just a few key triggers: oil prices, whether they continue rising or stabilize; central bank signals, especially any shift toward rate cuts; and earnings, whether big tech can sustain this growth momentum. Because right now, the market isn't lacking optimism, it's lacking certainty, and until that clarity arrives, expect volatility to stay just beneath the surface.